Okay, so we've been doing PPE for the last 2 weeks, and today we're moving on to the next topic, which is investment property. Let me just calibrate quickly. I don't know. All right, so this week we're doing investment property, and investment property is covered in IAS 40. So all these PPE sections that we're doing are all still covered by old IASs, IAS 40. Property in a set of books can be classified in a number of different ways. So property can be PPE. It's PPE if it's being used. So any property that's being used by the business, whether they be using it for admin, to have an office, or for manufacturing, to house machinery, or warehousing, it's PPE. Property can also be inventory. If somebody is a developer of property, then property for that person is inventory. The third place we will sometimes see property is in assets held for sale. Non-current assets held for sale. We're going to be looking at non-current assets held for sale later in the module. Non-current assets held for sale. And property can be investment property. So it's very important for you to look at the definition of the property and what it's being used for, or how it's being used by the company, to then determine which of these it's going to be, so that you can account for it correctly, isn't it? The statement defines, IAS 40 defines investment property, and I suppose that's the first most important piece of IAS 40 is the definition of investment property as a property which is held for capital appreciation. So in other words, I'm holding a property which I'm not using. I'm holding it just for capital appreciation. So not use. Or it's held for rental income. So if I have a property that either I'm not using, I'm just holding for capital appreciation, I've bought a building, I've bought a holiday home, I've bought a piece of land, and I'm not using it, I'm holding it for capital appreciation, then that property is considered to be investment property. If I have a property that I have to earn rentals, that property is considered investment property. Yeah? And you'll see that in your notes, we talk about examples of investment property. It says land held for long-term appreciation, land held for an undecided use. If I haven't decided yet what the land is for, it's investment property. A building that's leased out to somebody else, a vacant building that we're holding and the intention is to lease it out, property that's being developed for use as an investment property. What is not investment property is property that I'm using, property that I'm holding for sale, property that I'm holding for that's being constructed or on behalf of a third party. And they also talk about any property that we have where the intention is to develop for own use. So if I have land, but my intention is to build a factory on it, it's PPE. If I have land, my intention is to build a building or a shopping center that I'm going to rent out, then it's investment property. If I have land where I don't know what I'm going to do with it, it's investment property. Yeah. What you'll see later, we're going to look at with investment properties, we're going to look at what happens when my intentions or my use of this property changes. And what I will have is I will have transfers between investment property and inventory, or investment property and PPE, or, you know, back and forward transfers. And we're going to look at transfers a little bit later in the lecture. But for now, let's look at some examples, or an example that's in your study guide, which deals, it's example 1. It's on page 84, and it deals with a couple of properties and your decision about whether these properties are investment property or not. So the first one says, Tinta expanded its business to a small rural town. They bought an old house that they've converted to offices. The business in the town is growing, and the house is not fully occupied by the company. The house has a small flat attached to it that's currently being rented out. This part of the house will eventually also be occupied by the business. What do you think? PPE or investment property? PPE, yeah? Okay, so the house itself is definitely PPE, because the house itself we're using, isn't it? What we have is we have a flatlet. The flatlet we're renting out. So the rule in investment properties, and I don't think you'll come across this, but the rule in investment properties is if you can separate out the two pieces, and if you can actually identify costs and values and separate them out, like we did with components. Do you remember with components we separated out? If you can separate out, then you separate out and you would have the house in PPE because it's being used, and the flatlet in investment property because it's being rented out. Yeah? If you can't split it out, and remember there's that requirement in framework, which is that any measurement must be reliably measured, isn't it? So if we can't reliably split it out and measure it, then the rule is it's PPE. Yeah? So the rule or the definition will always lean to PPE if there's any doubt. So that's the first one. The second one, we own a piece of land. There's a possibility this land will be expropriated by the local council for a new road. Do you know what expropriation means? Government comes, says, we want to build a new road here, your property's on it. We will buy it from you. And they determine a fair value and they buy it from you. You don't really have a choice in the matter. Yeah. What you can do is you can go to court and complain that you haven't been given a fair price. But in terms of if it's just empty land and they want to extend the highway or make the highway bigger, they will expropriate that land. Tinta's original intention was to develop its head offices there. They've decided to wait before they do that. So which one do you think that is? They've decided to wait. The land is going to be expropriated. It's an uncertain, isn't it? I think it's an uncertain. Let me just see exactly what it says. My feeling on it would be that it's uncertain future use, and so therefore, what page did I say this was on? 90 something. Oh, it's back. But I don't see an example there. But yours is not 94, right? 84. Okay, so what they say is that they say that property 2 will be classified as owner-occupied property because any property that's held for intention for future use should be classified as owner-occupied. They say the fact that there's uncertainty regarding the future use doesn't change their intention, which is to build a head office on it. Okay. So that's that argument. Property 3, Tinta and all its subsidiaries are occupying a building that Tinta owns. The subsidiaries pay a market-related rental. The building is occupied 30/70 by Tinta and its subsidiaries. The intention is that Tinta and its subsidiaries will move to new head offices, and the existing building will then be held until it can be sold for a good price. At the moment, we are occupying it, isn't it? And it's being occupied 30% by us. 30% is quite a lot, isn't it? So this one is another one of those. If we can split out the building into the different, floors or something like that, we might split it out. Otherwise, if we can't split it out, 30% is just too big an amount for it to be classified investment property. Yeah, so in this case, it would also be PPE, but you'd have to use your judgment. What the statement says is that if you occupy an insignificant portion of the building, then it can be investment property. But for me, that insignificant portion is something like you have an office because you own the building and you're the management of the building. So you have an office for the building manager. And that office is yours, but everything else you rent out. In that case, it's investment property, clearly, isn't it? When we start to have these mixes, you have to ask yourself, what is the true nature of this? But for your purposes, you will always be told, it will be clearer, it won't be this uncertain, isn't it? Because then you could get the accounting completely wrong. But you will be told whether we are using or renting the property or whether the property is lying empty and what the intention is. And from there, you need to decide if it's PPE or investment property. If you take a property and put it into PPE when it's investment property, you'll get 0. If you do the opposite, you'll get 0. Okay. All right, so that's definition of an investment property. It's a property that is held for capital appreciation, not for use or for rental income. Any use or sniff of use, we start to lean to PPE. Yeah? All right, let's look at measurement. So when we look at investment property and we look at measurement, we have initial measurement, and initial measurement is exactly the same as PPE. So I'm going to put a little thing. Exactly the same as PPE. Remember, this is a property. So with properties, some of the initial costs of a property are things like lawyers' fees and things like registration fees to change the names, isn't it? It's all of those kind of costs. Lawyers, registration, it tends to be that kind of cost. It's not like a machine that's being delivered, isn't it, and installed. So all costs to bring the asset into use or ready for rental are considered to be part of initial measurement. Yeah. Then, so initial measurement is the same as PPE. The kind of costs that you'll get might be a bit different if it's property. Then subsequent measurement is where it's completely different. Okay. Subsequent measurement. What the statement says for subsequent measurement is, number 1, you're allowed to use the cost model. If you use the cost model, it is once again the same as PPE. We determine a life, we determine a residual, we depreciate, we check impairment. Yeah? However, most of the time, investment property is measured at the second allowed option, which is to measure it at fair value. And initially, this fair value, you're going, okay, that's not really different to PPE. Is very different to PPE, and I'll explain to you why. This fair value measurement for investment property is done every year. Every year at year end, we determine the fair values of property, if it's investment property, and we remeasure every year. Because we're remeasuring every year, there is therefore no depreciation. We don't depreciate. What's the point of depreciating and then we remeasure in the same year? We depreciate, we remeasure, we depreciate. There's no point, isn't it? The reason we depreciate PPE is because PPE, we only need to revalue periodically. So we would only revalue every 2 years, every 3 years, isn't it? So in between, we remeasure. Investment property gets measured at fair value. We measure it every year at fair value. So we therefore don't depreciate. The other key important thing with this investment property is that the fair value adjustment goes to P&L. The fair value adjustment on investment property goes to P&L. If you remember with PPE, when we revalued, we took that reval to reval surplus, isn't it? We took it through OCI to a revaluation surplus. This one goes through P&L and therefore lands up in retained earnings. Yeah. So you can see the very key difference between an investment property and a PPE. A PPE I'm using. The fact that I'm using it will reflect in my P&L as depreciation, isn't it? If I wanted to reflect in my financial position at fair value, I revalue it, but I don't put that into my P&L. I just take that into equity for now until it's sold, isn't it? With investment property, my intention is the opposite. My intention is to make money off this property. It's not to use it, isn't it? So if my intention is to make money off the property, then I'm going to measure it at fair value. And the movements in that fair value, that value of that property that I'm making money off, are going to go into my P&L each time. That's investment property. So that's subsequent measurement. It's fairly simple, and I think that if you did first year last year, if you did 1601 last year, we would have done investment property. If you did it earlier, then we would not have done it. You would not have done investment property before, okay, because it was introduced into the 1601 syllabus, I think last year sometime. All right, then we move on to presentation and disclosure. Presentation and disclosure. So presentation, on the statement of financial position, it's a separate line. It's a separate line in non-current assets, investment property. In the P&L, it will either be in other income or it will be in other expenses, the fair value movement. Then also in other income, we're also going to have the rent income if we've rented it out. And in other expenses, we're going to have property expenses to do with this property. And those property expenses could be as straightforward as things like rates and taxes. It could be rates and taxes, insurance, security, maintenance, right? Other expenses would go in there. So in the P&L, we have the fair value movement sitting in other income or other expenses, depending if the fair value movement was an upward movement or a downward movement. Agree? And then it also included in other income, we'll have the rent income, and also included in other expenses, we'll have the property expenses. And there's a requirement in the standard that says these property expenses in the PBT notes. So all these things, by the way, go into the PBT note. That goes into the PBT note. That would go into the PBT note. All these things go into the PBT note. Yeah, that's for disclosure. One of the disclosures. In this PBT note, these property expenses, these ones here, the statement says you must separate the ones that are earning rent from the ones not earning rent. So if I had a property and I rented it out for 6 months of the year, the other 6 months it was empty, or it was being fixed, yeah, I needed to fix it, I needed to redo tiling, paint, whatever, and then it got rented. I still have expenses regardless of whether I'm renting it or not. I have to pay rates and taxes, water and lights, isn't it? Insurance, regardless of whether I'm renting. So what the statement says is in the note, you must separate the expenses, whether you're earning rent in the time that you were earning rent and in the time that you weren't. So you would do it by months, isn't it? So it might be 6 months I was earning rent. So take all my expenses, take 6 months of those and put them there. 6 months I wasn't earning rent, take those and put them there. The other note that we have is the investment property note. The investment property note is similar to the PPE note. It's also a movement note. And there's only one difference, key difference with that investment property note. And if you get it wrong, it could mean that you will get 0 for that question. And that is that in this investment property note, NB, land and buildings are together. It's one category. One category. So you know in PPE we have a column for land and a column for buildings. And then a column for machinery and a column for vehicles, isn't it? Like that. In investment property, it is one column. You will take your land, you will take your building, you will add them together. And it will be one category, one column. If you do, you'll see sometimes in their stuff, they have the 2 columns and a total. But they usually put the 2 columns in a box and they gray it out and they say that's for information only, or that's the workings. Yeah. But I would never make that mistake. Just do your workings separate with the 2, but then when you push it into the note, it is 1 column. Yeah. Land and buildings is 1 category. So if you have a look in your handout, no, it's not that one. That's a transfer. Have a look on page 110. So you'll see here in the profit before tax note on page 110, profit before tax. Profit before tax includes the following: rent received, fair value adjustment. Yeah, there's the 2 income pieces. And then under expenses, direct operating expenses of an investment property that generated rental income and an amount. Yeah. If there was a period where there was no rental income, and you'll see that here, the rent income was for 12 months, so the property was rented for the whole year. If the property hadn't been rented the whole year, you would have another line here that would say direct operating expenses of investment property that did not generate rental income, and you would put the amount there, yeah, extra. All right, so far it's easy, right? So far, I just want to add so far investment property is easy as pie. Yeah, all I do is I remeasure at fair value every year, and that difference goes into P&L. Yeah, it's easy to do. They will give you the fair value amounts, and that's all you're doing. Now, I had spoken to you in the beginning about transfers to and from. Okay, so because property can be many things, we often see transfers in or out of investment property. And in this module, we're going to look at transfers in or out of investment property and PPE, between the 2. Because we don't cover inventory in this module. Oh, we'll see a little bit later when we talk about non-current assets held for sale, sometimes a transfer to non-current assets held for sale. But for now, for this module, we're going to talk only about these transfers in and out of investment property. And there's one rule. The rule is remeasure first, then transfer. Remeasure first, then transfer. That's the rule. So, if it was PPE, if I was using it, and then I decided that I wasn't going to use it anymore, that I was going to move to Sandton or whatever, and now I still have that property, but I'm going to just rent it out. So, for example, one of my clients that I work with is Coca-Cola. They have a very nice building, 2 buildings in Parktown, yeah, opposite the Park Lane. But they've recently decided that they need to move, and they're going to move to Rosebank or Sandton into a nice big new building. And so now that building is primed to be rented out to doctors, isn't it? If they can fix it up and partition and whatever, because it's right there by the hospital, and the hospital, there isn't a lot of space, so either the hospital can take it and put some of their sections there, or doctors. So if we had a PPE that then becomes investment property because you've moved out, yeah, and we must be very careful with this date. This date, let me put it here. The date of the transfer is the date of change of use. So when I stop using it, that's when it becomes investment property, because then it doesn't fit the definition of PPE anymore. Do you agree? When I start using it, so I look at when I stop using it and when I start using it. It's the change of use date. All right, so the date that I move out of my property and I'm no longer using it, and maybe it doesn't get rented immediately because they need to fix it up, they need to find the right tenant, etc., etc. But that date, the date that I move out, that I'm not using it anymore, that PPE needs to become investment property, isn't it? So what do I do then? I will have a balance at beginning of year. I depreciate, let's say it's for 3 months, and I get a carrying amount at the change of use date, and then I revalue to get to a fair value at the change of use date. And then once I have a fair value at the change of use date, then I transfer to investment property. And once I've transferred to investment property, then my balance that should be left in PPE will be null. Yeah? So you'll be happy to know that when I do the transfer and I do a reval, I don't do that like backward to beginning of year story. I just do it on that date and I move on. Yeah? So that's what happens when I have a transfer from PPE to investment property. I've got the PPE at beginning of year according to what it was in PPE. I depreciate up to the change of use date. At that date, I remeasure it to fair value, revalue it to fair value, and then I transfer it to investment property and I'm left with null. In investment property, I will have a transfer in at some point in the year. I will have a fair value adjustment, and I will carry it, so beginning of year is null. I will have a transfer in, I will have a fair value adjustment, and I will carry it at fair value at end of year. This fair value adjustment over here goes to P&L. This revaluation over here goes to OCI reval surplus. Yeah? All right, so that's a transfer from PPE to investment property. So when it was PPE, I will depreciate it up to the date I stopped using it, because I was using it for those 3 months. That depreciation must reflect in my P&L. Then I will revalue it to the fair value on that date, and then I will transfer it out and take it to investment property. In investment property, I would have started with no investment property, presumably. I will transfer in from PPE, and I will do a fair value adjustment to get me to the fair value at year end. In this case, they will give you two fair values. They will give you a fair value at that date of change of use, and they'll give you a fair value at year end. Yeah? If we have the other way around, so if I'm going from investment property to PPE, so I could also have that. I had a property that I had bought in Cape Town. I was renting it out. I've now decided to open up a branch in Cape Town, so now I'm going to use it from now on. Yeah? Do you agree? So what happens here is I had a fair value at beginning of year. It was investment property at beginning of year. There would be a fair value at beginning of year because investment property is always carried at fair value. Yeah? I then do a fair value adjustment to get me to fair value at change date. This fair value adjustment goes in P&L. I do a fair value adjustment to get me to fair value at change date. I then transfer to PPE, and I'm left with null. So this transfer to PPE comes here, and beginning of year in PPE, let's assume I have no other properties. I don't know what it was. It was a different property, yeah? So I have a beginning of year balance there. I have a transfer in from investment property. And then I will depreciate for however many months I use it. Do you agree? And then I have a carrying amount at end of year. Then, once it's in PPE, I have to look at what is my policy for PPE. Is my policy for PPE to carry at cost or to carry at fair value? If it's to carry at cost, I just keep going. If it's to revalue, then they need to give me a reval at end of year, isn't it? But maybe it doesn't even get revalued then. I don't know. So this is the example of transfers out, and this is the rule. We remeasure first, and then we transfer. Okay, and you saw it there in both of those. All right, so if you have a look in your study guides, it's example 6. I want you to practice it, doing the calcs for me. And you're just going to do 2 simple notes, a PPE note and a investment property note, just for the property. So it says, Semstone acquired an office building 1 July 05 for an amount of 4.5 million rand. Land was 750, buildings was 3750, example 6. The building was available for use as intended by management on 1 August 05. It was determined to have a useful life of 35 years and a residual value of 500,000 rand. The life and residual have remained unchanged. During the current year, they decided to rent out 95% of the office space to a suitable tenant. So we acquired a building, the building was available for use, and it was being used. During the current year, they decided to lease out, and a 3-year lease was effective from 1 December, was concluded at a monthly rental of 25,000 rand. The tenant occupied the building from 1 December. Now, the information in this question for me is not great because I'm not looking at when the tenant occupied the building. I should be looking at when did I stop occupying the building. Do you agree? So that's the information you should have been given. The information you should have been given was about your use, not about what you're renting or when you're renting. Because there could have been a gap between your use and rent, isn't it? And there often is. The respective, and the fact that they've rented out 95% means that you're occupying maybe one office as like the building manager. All right, the respective replacement values and fair values of the office building were as follows. 28 Feb 10, 1 December 10, 28 Feb 11. So if I just, without even looking, it's fairly clear that this is beginning of year, this is end of year, this is change date. Do you agree? All right. What we don't know now is how they measure investment properties and PPE. You have to know how they measure it because there are always 2 options, cost or fair value. If they both measure at cost, then we can ignore all the fair values because if it's cost, it just goes cost to cost, and we call. Okay. All right, let's see what else it says here in the question. Ignore the machinery, by the way. You can ignore that machine. It says, during the 2010 year, the Board of Directors decided to disclose PPE at their net replacement values. It's the accounting policy to apply the fair value model to investment property. It's the accounting policy to provide depreciation, straight line, and machinery, okay, we're not worried about. All the replacement values and fair values were determined by Mr. Koza. Mr. Koza has recent experience, and his values were determined by reference to market values. It's the company's policy to realize the reval surplus on sale. All right, so I want you to do the 2 notes. I just want you to do land, buildings, investment property. So it will look very simply. You're going to have PPE on this side. You're going to have land, building. It's going to start with beginning of year and end on end of year. And you're going to have investment property. Remember, investment property is land and buildings together. And you're going to start with beginning of year and end with end of year. And I just want to see those movements. Okay, has everybody got a study guide? Yeah. Okay, so I'm going to leave this one on so you can see what it is that I want. And It's example 6. I'm going to give you a bit of time to try and do that. All right, so I cheated a bit. I didn't do that box, right? The boxes. And because I was writing in dual view, it's come out looking enormous. My goodness. Let me do that rather so it looks a bit smaller. Okay. We start the year in PPE, and a revaluation has just been done. Do you agree? They said to you it was revalued at the end of last year, February 10. So a revaluation has just been done. So in PPE, the values at beginning of year are those revalued amounts, isn't it? I cheated. I didn't do the box because the box meant that I had to work backwards a year to do the reval, as we've learned to do last week. So I just started with the carrying amount. So the carrying amounts at beginning 710, 3410 is the revalued amounts that were brought forward. And I determined the remaining life. The original life was 35 years. 35 by 12 is 420 months. And then I worked out the months. I initially worked them out wrong because I was so caught up in trying to get the months right that I didn't read carefully, and I had read it the first time, that it was only ready for use the 1st of August, not the 1st of July. So you're working from 1 August 06, 05. So you go August, September, October, November, December, January, February. 7 months to get you to February 06. Then from February 06 to February 10. 7, 8, 9, 10, another 4 years. So 4 times 12 is 48, plus the 7 months is 54. Is that right? 55. 55. 55. There were 420 in the beginning, we said. So now there are 365 remaining. Months remaining. So I start the year, there are 365 months remaining when I did that fair value, that reval. That was the reval I did, and the residual value was 500,000. I then depreciate. I'm going to depreciate until the 1st of December because that's the date it changed and I transferred. So I depreciate from 28 February, March, April, May, June, July, August, September, October, November, 9 months to the end of November, right? To the 1st of December. I depreciate for 9 months. 3410 minus the 500 residual divided by 365 months times 9 months. Yeah, gives me 71,753. So that building first needs to be depreciated because I used it for those 9 months. That must show in my P&L, use. Then I get to the 1st of December. Now I changed my use.